Understanding mutual funds, a beginner's guide, fundamentals. Types of mutual funds. Index funds. These funds aim to replicate the performance of a specific market index, such as the S&P 500. They typically have lower management fees than actively managed funds and are considered to be a passive investment strategy. Actively managed funds. These funds are managed by professional portfolio managers who make investment decisions based on their research and analysis. They typically have higher management fees than index funds and are considered to be an active investment strategy. Sector funds. These funds invest in a specific sector or industry, such as technology or healthcare. They can be either actively or passively managed and are considered to be more risky than diversified funds. Bond funds. These funds invest primarily in bonds, which are debt securities issued by governments and corporations. They typically have lower volatility and provide steady income. Balanced funds. These funds invest in a mix of stocks and bonds and aims to provide both growth and income. Target date funds. These funds are designed to adjust the investment mix over time based on a target date, such as retirement. It's important to note that mutual funds are not suitable for all investors and you should consult with a financial advisor before making any investment decisions. How mutual funds differ from individual stocks. Mutual funds and individual stocks are both types of investments, but they have some important differences. 1. Diversification. Mutual funds pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. This diversification helps to spread risk and potentially reduce the overall volatility of the fund. On the other hand, investing in individual stocks carries more risk as the performance of the stock is dependent on the performance of that specific company. 2. Professional management. Mutual funds are managed by professional portfolio managers who conduct research, make investment decisions and manage the fund on a daily basis. On the other hand, an individual stock is managed by the company and the individual investor has no control over the company's decision-making process. 3. Fees. Mutual funds generally have higher management fees than individual stocks. This is because mutual funds require professional management, and the management team needs to be compensated for their work. 4. Liquidity. Mutual funds are generally more liquid than individual stocks. This is because mutual funds can be bought and sold on a daily basis, whereas the buying and selling of individual stocks is subject to market conditions and can take longer to complete. 5. Risk. Investing in mutual funds is generally considered to be less risky than investing in individual stocks because of the diversification and professional management offered by mutual funds. It's important to note that mutual funds and individual stocks both have their own unique risks and potential benefits, and it's important to consult with a financial advisor to determine which investment strategy is best for you. The benefits and drawbacks of investing in mutual funds. Diversification. Mutual funds allow investors to invest in a basket of stocks, bonds, or other securities, rather than putting all their money into one stock or bond. This helps to spread risk and increase the chances of earning a profit. Professional management. Mutual funds are managed by professional money managers who have access to research and analysis to make informed investment decisions. Convenience. Mutual funds are easy to buy and sell, and can be easily held in a brokerage account. Drawbacks of investing in mutual funds include fees and expenses. Mutual funds charge management fees, which can eat into returns. No control over portfolio. Investors have no control over which securities are included in a mutual fund, so they must rely on the fund manager's investment decisions. No guarantee of a profit. Mutual funds, like all investments, come with the risk of losing money. How to evaluate and select a mutual fund. 1. Investment objective. Understand the fund's investment objective, such as growth, income, or a balance of both. Make sure the fund's objective aligns with your own investment goals. 2. Performance. Look at the fund's historical performance over different time periods to get an idea of how it has performed in the past. Be aware that past performance does not guarantee future returns. 3. Risk and volatility. Review the fund's risk and volatility, which can be measured by its standard deviation or beta. Compare these figures to those of similar funds to understand how the fund has performed in different market conditions. 4. Fees and expenses. Review the fund's expense ratio, which is the annual fee charged by the fund's manager as a percentage of the fund's assets. Lower expense ratios can mean more money in your pocket. 5. Portfolio holdings. Review the fund's portfolio holdings to understand what types of securities the fund is investing in and how diversified the portfolio is. 6. Fund manager. Research the fund manager's background, investment philosophy, and track record. A good fund manager can make a significant difference in the fund's performance. It is also important to review the fund's prospectus and statement of additional information, which provide more detailed information about the fund's investment strategy, risks, and fees. The role of mutual funds in a diversified investment portfolio. Mutual funds can play an important role in a diversified investment portfolio by providing exposure to a variety of different securities, such as stocks, bonds, and other assets. By investing in a mutual fund, an investor can gain exposure to a diverse group of securities in a single investment, which can help to spread risk and reduce the overall volatility of the portfolio. For example, an investor who wants to invest in stocks but is concerned about the risk of investing in a single stock can invest in a stock mutual fund which holds a diversified portfolio of stocks. The investor would then be exposed to the overall performance of the stock market, rather than the performance of a single stock. Mutual funds can also provide professional management, which can be beneficial for investors who do not have the time or expertise to manage their own portfolios. Additionally, mutual funds can also provide liquidity, which means that they can be easily bought and sold on the open market. This feature can be useful for investors who want to quickly adjust their portfolio according to market conditions or personal financial situation. It is important to remember that diversification does not ensure profit or protect against loss. It is also important to ensure that the mutual funds that are selected align with the overall investment goals and risk tolerance of the portfolio. Tax implications of investing in mutual funds. Investing in mutual funds can have tax implications, both on the income earned from the fund and on the capital gains realized when shares are sold. Income tax, interest and dividends earned by the mutual fund are taxed as ordinary income to the shareholders at their marginal tax rate. Capital gains tax. When shares of a mutual fund are sold, any gain or loss is considered a capital gain or loss. If the shares are held for more than a year, the gain is considered a long-term capital gain and is taxed at a lower rate than short-term capital gains. If the shares are held for less than a year, the gain is considered a short-term capital gain and is taxed at the same rate as ordinary income. It is important to note that mutual funds also distribute capital gains to shareholders, which are taxed as income even if the shareholder does not sell their shares. Additionally, some mutual funds invest in foreign stocks, which can also have tax implications. Foreign taxes paid by the fund can be credited or deducted on the shareholder's tax return, but it is important to consult with a tax professional to understand the specific implications. It is important to consult with a tax professional to understand the specific tax implications of investing in mutual funds, and to consider the tax implications when making investment decisions. The impact of interest rates on mutual funds. Interest rates can have a significant impact on mutual funds, as changes in interest rates can affect the value of the underlying securities held in the fund's portfolio. When interest rates rise, the value of bonds and bond funds tend to fall, as the fixed interest payments on bonds become less attractive relative to newer bonds with higher interest rates. This can result in a decline in the value of bond funds, which hold a portfolio of bonds. On the other hand, higher interest rates can benefit funds that invest in stocks, as higher interest rates can make it more attractive for companies to borrow money for expansion and growth, which can lead to increased corporate profits and a rise in stock prices. However, when interest rates fall, the opposite happens. Bonds become more valuable as they offer higher interest rates than new bonds, and stock prices can also decrease as investors shift their money to bonds. It's important to note that the impact of interest rate movements on mutual funds can be complex and depend on the fund's specific investment strategy and portfolio holdings. It's always recommended to consult with a financial advisor or conduct your own research to understand how interest rate movements may affect your mutual fund investments. How to use mutual funds in a retirement savings plan. Mutual funds can be a useful component of a retirement savings plan. Here are a few ways in which mutual funds can be used in a retirement savings plan. 1. 401k or employer-sponsored retirement plans. Many employers offer 401k plans or other employer-sponsored retirement plans, which allow employees to contribute a portion of their salary to a retirement account. These plans often include a selection of mutual funds as investment options. 2. Individual retirement accounts, IRAs. IRAs are personal savings plans that offer tax benefits for retirement savings. Mutual funds can be held within an IRA, which allows investors to take advantage of the diversification and professional management offered by mutual funds, while also enjoying the tax benefits of an IRA. 3. Target date funds. These are mutual funds that are designed for retirement savings and automatically adjust the investment mix over time to become more conservative as the target retirement date approaches. These funds can be used as a set it and forget it option, as they take care of adjusting the portfolio based on the investor's retirement date. It's important to note that mutual funds, like any investment, come with risks, and it's important to conduct your own research or consult with a financial advisor to understand the specific risks and potential returns of a mutual fund before investing in it. It's also important to diversify your retirement portfolio by including other investment options like bonds, stocks, and real estate.